Many retail traders insist the sudden margin increase was engineered to deliberately pop the gold and silver bubble. In their view, the big guys saw regular investors making money and said, "Nope, not on our watch." Raising margins forces many traders to sell, which helps drive prices down. How convenient. A popular scapegoat is JP Morgan. There's long been chatter that big banks manipulate the silver market. When prices tanked, fingers pointed at JP Morgan, claiming they wanted to protect their own massive short positions. If silver's spike was hurting some too-big-to-fail players, surely they pulled strings behind the scene, right? It's the classic David's versus Goliath narrative. It's a juicy story. The idea that when the little guys start winning, the house changes the rules. And let's be honest, after watching brokerages restrict buying during the GameStop saga, it's easy to see why people are quick to jump to these conclusions. Let's look at a less thrilling but far more likely explanation. What really happened with those margin hikes? In one word, risk. This was not an Illuminati masterstroke. It was the exchanges doing what they always do when things get wild, covering their butts. To understand this, we need to talk about what margins are and why they matter. Last week's gold and silver trading was anything but normal. These markets went haywire. Gold and silver didn't just slide gently, they went off a cliff. This wasn't your everyday volatility, it was a full-blown freak event. In statistical terms, traders were calling it a Six Sigma meltdown, meaning a price swing so extreme it shouldn't happen more than once in a million years if markets were normal. Obviously, markets aren't perfectly normal, but you get the point. It was insanely rare and violent. CME's risk managers were watching a nightmare unfold. Put yourself in the exchange's shoes. CME's job is to make sure that every trader can pay what they owe at the end of the day. When you see a market move this extreme, you worry that yesterday's margin requirement might not be enough to cover today's losses. If a bunch of traders can't meet their margin calls, the exchange or clearinghouse might be on the hook for the shortfall, and that is unacceptable. This is why CME acted. Gold futures margin went up from 6% to 8% of the contract's notional value, and silver futures margin jumped from 11% to 15%. In fact, just a couple weeks earlier, CME had even changed its whole margin setting methodology. Instead of using fixed dollar amounts, they shifted to a percentage-based margin system for metals. Why? Because gold and silver prices were soaring so fast that a static margin amount kept getting out of date. By using a percentage, the required margin automatically scales up with the price. In other words, CME was already bracing for turbulent times by making margins adjust with the market. Now, let's acknowledge something. Raising margins does put short-term pressure on the market. It's not crazy to note that a higher margin requirement can knock prices down further, but it's due to mechanical reasons, not because the exchange is evil. Think of margin hikes as the fire department pouring water on a blaze. Sometimes the water damages the house, but the goal is to save the neighborhood. Here's how it plays out. When margins go up, traders need more cash on hand to maintain their positions. For highly leveraged speculators or small retail traders, this is a big deal. If you're a small trader and suddenly you need thousands of dollars more today to keep your silver futures, you might not have that money. So what do? You sell some contracts to reduce your exposure. Multiply that by hundreds or thousands of traders all getting margin calls at once. And what do you get? More selling. And more selling leads to lower prices. It's a vicious cycle. Falling prices trigger margin calls force more selling, and that selling drives prices even lower, which triggers even more margin calls. Here's an ironic twist that conspiracy theorists overlook. Exchanges actually benefit from booming markets. Think about it. CME Group makes money from trading volume. The more contracts traded, the more fees they collect. And when do people trade like crazy? When the market is hot and exciting, when silver is shooting up to new highs and every Redditor and their grandma is trying to get a piece of the action. Case in point, during the recent silver frenzy, the iShares Silver Trust ETF, SLV, which is a proxy for silver demand, traded an all-time record volume. On one frenzied day, SLV saw 393 million shares change hands, worth about $38 billion, its highest volume ever. So the notion that CME would intentionally sabotage a bull market that's bringing in record trading business, it doesn't pass the smell test. As a business, the exchange wants active, liquid markets. Ideally, they want as many participants as possible trading as often as possible. They'd actually prefer to keep margin requirements as low as prudently possible to lower the barrier to entry and let more people trade. Low margins mean small traders can participate and big traders can leverage more, which boosts volume and, by extension, exchange revenue. The only thing that stops CME from lowering margins is, again, the risk factor. They want lots of trading and no defaults. It's a tough balancing act. When you strip away all the dramatic narrative, the real reason behind the CME's precious metals margin increases is straightforward. The exchange was freaking out about risk. Gold and silver were whipsawing beyond anyone's expectations, and CME did what it's supposed to do: make sure the financial plumbing can handle it by requiring more collateral. Yes, this had the side effect of damping the speculative frenzy and likely hastened the price crash in the short term. No, it wasn't a move designed to specifically protect or enrich some secret insiders at the expense of retail. It was about preventing a bad situation from becoming worse.